Good morning, ladies and gentlemen. My name is Roger Scott, and I'd like to welcome you to the Midweek Roundtable. With me, we have our usual co-host. We're the two troublemakers, Roger Scott, Jeff Zananeri. I'm just messing around about the troublemaker part. Unless you ask our wives, right?
No doubt. No doubt.
Of course. I tell my wife, I said, I'm a guru at Wealth Press, but you still make me take out the garbage at home.
There's one boss, man. There's one boss. You figured it out early. You have a nice long life.
I couldn't have said it better myself. Folks, if you'd like to reach out to Jeff, please do. He will not bite. Jeff@joyofthetrade.com. And my email is support@marketgeeks.com. Easy, simple. You can get a hold of us both that way if you have questions. Also, I recommend you take a little piece of paper and take some notes. This is not a scripted conversation. We haven't really talked in a week. We chat on Slack, but we don't really talk. So we're really going to talk about what we're seeing, how the market's reacting, what we think about the Fed, so forth and so forth. Please pay attention. This is important stuff. Between us, we've got over 50 years of experience, real experience. I know it sounds old, right?
It's good though. It's good.
Yeah.
I feel comfortable. I feel like an old pair of jeans or something.
That's what I tell my wife. I said I don't really mind aging because I feel like I'm learning as I go through the journey. Unlike
sports, where like there's a big premium on youth, in the markets there's a premium on wisdom.
Exactly.
And experience.
Yeah, I've seen guys. I've seen guys do what we do. I forgot his name, old guy, James something. He does gold. I think he's well in his 80s. I just don't, the name escapes me. But anyhow,
yeah,
the markets are crazy. Yesterday down 300 points, today up 300 points. Before we get into the nitty gritty, I want to talk to you about my favorite Fed. I want to ask you a question. Please, I want to ask you this question. I went on this tangent for about 5 minutes in my morning video today. The market's down yesterday, right?
Right. Yeah.
We don't know. We honestly don't know. I mean, we could speculate, but we don't know what this Omicron is going to bring to the table. We have no idea.
Yeah.
I mean, we don't really know. Yeah. It may be
There's some unknowns.
Yeah. It may be a nothing burger. It may be the biggest thing in the world. This guy's already broadcasting yesterday. He couldn't just say, we'll see what we'll do next month. He couldn't just hold it. He had to say, we're going to continue tapering next month. And boom, the market drops another 400 points.
He did it even worse. He said, we're going to accelerate our tapering. Yeah, here's the thing. When you make incorrect, bad decisions, it becomes like a pattern of bad decisions. The original sin was not recognizing inflation 6 months ago, 7 months ago, and calling it transitory at the beginning of the summer and saying, well, this is not a big deal, when it was a big deal and they were out of control. And by not recognizing reality, right? So it's almost like they're disconnected from reality by not recognizing, by not acting, by not discontinuing to buy. Why are they buying mortgage bonds at all-time highs? In the housing market's at all-time highs. We have bubbles in a lot of parts of the United States in real estate. And it's a massive contributor to inflation. So why are they buying these bonds? Why? And so by not doing the right thing back then, it's compounding a series of errors. So now they're like, I've been saying this on this show for a few months now. They're going to be forced to taper faster than they want to and raise rates. They're forced. The market's going to force their hand. They don't want to. And that's starting to happen at the worst time.
Right.
I think that Omicron, I'm not a scientist, but I think if it was super lethal, that they would know exactly who left South Africa and went to Holland. And they would be like this big web of interceptors of those people. And that's not the case. And everything we're hearing preliminarily from doctors in South Africa, and I don't know why they would lie about this, is that it's pretty mild right now.
Yeah.
I've
heard just to echo what your sentiment, I've heard that it's extremely contagious, but mild. That's what I heard.
Which is
Very
normal,
contagious, but mild.
which is a normal evolutionary process for a virus. Actually.
Exactly. And the truth is, I mean, look, look, if COVID, let's be honest with each other. If COVID was just something that made people sick a little bit and it was like a cold and nobody died, and nobody would make a big deal out of it. People died because of COVID. That was the key kicker. So if this thing is just
certain demographics of people died.
Right, but
children didn't die. Children didn't die. 500 kids in the United States have died. 350 of those kids were dying of something else. They were in long-term healthcare facilities. They don't talk about that.
I did not know that till now.
I'm saying in the United States. That's reality.
I did not know that.
A lot of people don't. The media goes out there and they say, it is dangerous. Listen, I'm not downplaying. I'm vaccinated. I'm not an anti-vaxxer, but I like to take everything within a measure of reason, right? And so my point is are you not doing what you were doing last month because of Omicron?
No, I'm planning. I'm going all the way, to be honest with you.
So everybody that's vaccinated like us, that feels strong, that feels healthy, I don't think this is derailing anybody's plans of how they're going about their daily life, I guess is the point that I was saying. If we had scarier news, I think people would like us, that are rational, reasonable people, would be like, you know what, babe, maybe we don't take this trip this winter. You know what, maybe we don't go to this concert. Maybe we do not go to this Christmas party. And I don't think that's happening. I don't think that conversation is really happening.
One thing I am changing. I really wanted to go to England in the summer. And I don't know I'll be able to do that, but not because of because they're restricting travel.
Because of rules.
Right. But it has nothing to do with.
Those are separate things.
Very separate things. Very separate things. So I'm with you 100%. But again, we want to be objective here, and we want to.
There's going to be headline risks for the next few months. There's going to be shoes dropping. There's going to be. We've been saying this, that there's going to be. COVID is not going away. So. Like, wipe that off your agenda. Like, if you think like we're going to beat COVID, that's like a BS like slogan on a bumper sticker. Like, it's a virus. We haven't beat influenza. It's still around. Like, these things don't go away. You manage them. You manage them with science, with medicine, with rational behavior, but you don't defeat them like you're defeating the Red Russian army or something. It's like, it's something we have to live with. So there's going to be scares. There's going to be news bombs. I think that the bigger risk to the stock market, let's get back to the stock market, is actually inflation. Yes. Even if they start tapering, I think it's too late. I think they've missed the boat on it. You might get a short-term pullback in oil, which we've seen, and they're already buying it back this morning. We're taping this. It's staying around 70, which is still a pretty high number. Still in a bullish uptrend. Hasn't broken down like some of the other commodities. Copper's bid again this morning. So I think you might get temporary transitory pullbacks in the prices of some goods. But like you shared with me and probably shared with some of your other people yesterday, the car prices. Talk about that for a second. These car prices. That was an awesome graphic, by the way.
Yeah, I figured a picture's worth 1,000 words. So just for, as I said, I talk with Jeff and other people in our company. We communicate via Slack during the day. And I was writing a report yesterday on car prices and telling people, and this is a statistics based on 460,000 data samples. And the graphic showed probably, I think, 15, 20 of the top selling cars like Toyota Tundra, not exotic cars, just everyday cars
normal
that people buy. Yeah. And between prices, sticker prices and used car prices from the year 2020 and 2021. And I think 90% of it, or most of it, the used car prices was higher by about $1,000 to $2,000. And just for people watching at home, in light of that, I think one of the best stocks to buy in light of that is CarMax and Advanced Auto Parts, AAP. And the reason, let me tell you why I say CarMax. I specifically have a very specific personal reason why. We recently sold one of our Jeeps and we bought a 4Runner, and CarMax gave us $4,000. I don't have any affiliation with CarMax. Wealth Press does not have any affiliate. I'm just throwing this out. This is a personal experience. CarMax gave us $4,000 over everybody else. And I recommended—
I did a similar thing. They were much higher than everybody else.
Yeah, and I recommended a friend do the exact same thing. His lease was expiring, whatnot. He went to CarMax. He had exactly the same experience.
They have margin. They're smart. They have enough margin, and they just want inventory.
Right.
There's
And
demand.
there's no inventory right now.
Yeah.
There's no inventory. And people are going to be driving cars, people are going to be buying cars, people are going to be leasing
So that's a
cars.
sticky price increase. Cars aren't going to go back down.
Of
Like,
course.
you think cars are going to come back down? It's like things that don't go back down are like car prices, wages. Wages are sticky. When you get these wage increases, those don't go back down. Right.
Right. Right. Sorry, I'm going to show off a little. I have a little kitten
Oh, what a
here
beauty.
running around. He's
Nice
a petite Persian. This is baby Louie, everyone. Let me put him
Baby
down
Louie.
and get serious again. Sorry, Jeff. I didn't mean to
No,
cut you
you're
off
good.
there.
So I guess what I'm trying to say is they've missed the boat. They've done irreparable harm to the economy. And then they're in a spot where they don't have any bullets to shoot. So let's say we do have lockdowns in the winter because we do have virus spikes and it gets a little bit out of control in the Northeast. I think it's a seasonal thing. I think they're going to have a bad time in the Northeast, just like we had a bad time in Florida in the summer, because that's seasonally when we get it, spring, summer. I think they're going to have a bad time in the Northeast in the winter, even with a high vaccination rate. Mild cases, but it's going to be widespread. It's going to be north of 5% infection rate. And I think they're going to be seeing some lockdowns, or not lockdowns per se, but restrictions. I think this country is like vehemently against lockdowns. They won't tolerate it. And so I think they're going to do what they can in terms of like restricting crowd sizes, big events, concerts, sporting events, how many people can be in a restaurant, yada, yada, yada. But those are the news lines I'm looking out for from the Northeast for COVID for the winter.
It seems to me, and I mean, we have very limited data, but so far as the Fed and Biden, they're acting like this Omicron doesn't what Omicron, but I think that's a good thing for now. I think for now that's a good way to deal with it because we really don't know. I just
They're in
wish
a bad spot. They're in a bad spot. The economy is vulnerable here. If you lock everything down, you don't have tools to re-stimulate things. What are you going to do? Rates are zero. You're going to have negative interest rates.
And Jeff, this is what you and I were talking about 2 years ago, by the way, how premature the Fed was, how they're behind the curve, and it's now all coming to fruition.
Well, if they stopped tapering 6 months ago, right, they could, and then they started winding down their balance sheet, they could reintroduce bond purchases and asset purchases, and they would have tools, but they don't have that capacity now.
No, those days are over. It's really and if bonds stop and if stocks stop reacting to bond prices and if that correlation starts becoming deader, they're going to be in deep doo-doo because they're not going to be able to regulate this thing. It could be a mess.
It's a tricky spot for this. I feel like the stock market's super tricky here too. Lots of stocks are smashed up. People are looking at their portfolios and they're like, how are we near all-time highs? A lot of these stocks have gotten beaten down. There's been a beat down in stocks like Disney, great companies. I think that's an attractive company long term.
I'm buying up blue chips right now. Travelers, GE, the hotel. Yeah. I think this is a overblown reaction. But speaking of stocks, tell me what stocks are you looking at right now? What's on your radar? What would you advise?
I think financials are really good here. I think financials are a good place to go fishing right now. I think they're going to raise rates. Rates are going higher, whether we want it to or not. Yeah.
Specifically, let me ask you, because you just raised a really interesting topic, or maybe opened up a can of worms for me. But when you say financials, obviously you've got banks, but what about insurance companies? What's your take on that? Because they really took a dump yesterday.
I like insurance companies. I like all financial companies. I think financial companies in general are going to have a lot of leverage in the future. Right now, they don't. Right now, they're strictly surviving on creativity and the volume of activity. But their margins are razor thin on how much they make. Their business is money. Their business is doling money out. And in that business, they have razor thin margins. And I think those margins are going to improve vastly because the higher rates go, the more they can take out, the more they can play. And I think that's invariably going to happen. It's inevitable. It's the only way they can combat this inflation. Did you see Italy had a 25% PPI print last week? It's 25%.
How is that even possible? I mean, that's insane. I mean, it's a small
country. They might be
country.
the only guys putting out honest numbers on the street. Who knows? But it's like, I feel like we're double digits in this country. Yeah. We've gotten used to 5-6%. Yeah, that's if you count like t-shirts that are being created in sweatshops or whatever. But everything people need, rent, food, gas.
Right. It's insane. I mean, I went to fill up my car yesterday actually, and it was like going back to Los Angeles.
Have you looked at hotel prices? They're having Art Basel. I'll send you this article. You're going to love this. Yeah. They're having Art Basel, world's biggest art selling event in the world in Miami this weekend. Big shots from all over the world come and spend tens of millions of dollars. art dealers from New York, London, Paris, they all come to Miami. And it's a massive local economic stimulus event. You know why? Because a normal night at the Fontainebleau, which would be like $300-400,
Right.
it's like $5,000
Wow.
weekend. Is a 10x increase on all Miami Beach hotels. 10x, dude, is what's
That's
happening.
crazy.
There's so much money in the system right now, and it shows up in these, really wealthy pockets of the world where luxury prevails. And I'm looking at this and I'm like, I don't think I remember a time where I've ever seen Miami hotel average rate like that. Like if I wanted to rent my house out for Airbnb for this weekend, I can make like the next 6 months worth of mortgage payments on it. Well, like I wouldn't want to have like crazy people partying in my house.
Of course. Right. Right.
Swimming in my pool.
No, of course. I totally understand that. Let me ask you this. If we got a lot of people right now because of the volatility, a lot of people at home are nervous for obvious reasons.
They should be. Yeah.
What advice would you give people at home in terms of positions, hedges? How would you say the best way to navigate the market over the next couple of weeks?
I think whenever you get into a volatile regime is what I like to call it, a volatile period of time. The first thing you need to do is assess your exposure and if you have leverage, if you have overexposure to certain stocks, to certain vulnerable areas, reduce your exposure a little bit and have a little bit of dry powder. And I'm not saying a wholesale puke of your position. I'm just saying get your portfolio under control where you can tolerate an average daily drawdown. What is an average daily drawdown? If we have a 2% decline in the stock market, that means some of your holding is going to be down 4%, 5% on the day. If you can't tolerate a 5% pullback in an individual day in an individual stock because it's just way too violent money-wise on what you consider a lot of money, then you need to draw that position smaller on the up days. Don't do it on the down days. So we get up days, we get down days. That's the beauty of volatility. You can trade them back and forth. So a day like this, for instance, the market's rallying back. Use this day not to buy more stocks and panic because you just sold your stocks yesterday, but use this day to sell into the bid a little bit of drawing down your position, raising a little bit of cash, because invariably we're going to have more pukes that you might put to work later down the line.
And let me just give you my 5 cents on this. Right now, I believe bonds are. I think bonds are going to be coming down. I think, as you and I both think, Fed has put themselves in a big corner. So I think the bonds are overreacting a little bit, and I think they are going to continue doing what they're doing. They're going to be tapering. So I think bonds will be coming down. I think the volatility will begin declining over the next couple of weeks. I think we're still coming
this month, December for sure.
Well, I think we're still up till yesterday. I think we were still feeling a light volume because of the holidays, and I think as liquidity comes into the market, and usually it starts coming into the market right around now, about 2-3 days after, because people are traveling, they took the weekend off, they come back Monday, Tuesday, they come. I think today will be the first big, complete full day of trading when people are back into in their element.
Yeah, you're right. Days back in.
So I think volatility. I'm looking at the VIX right now. I think the VIX is going to cool off a little bit, at least for now. For the time
I'm with
period.
you on that. you on that.
Yeah, I think the VIX is going to.
It's mean reverting to it. Did it spike? I think if we get back-to-back days without a sell-off, like so today we follow through with the bid all day, and then we have another update tomorrow. VIX will recede almost all the way back.
Yeah, that's so. I believe that. So I'm short bonds, bearish on VIX, and I'm just giving you the broad strokes here.
Yeah.
I am also. I'm very happy that you and I know some people think we talk about this beforehand, but we do not. This is the first.
No.
I'm very happy and relieved that you feel confident about the financial sector right now, because I feel exactly the way you do, and I think they're getting smoked right now for no good reason, and I think financials are the low hanging fruit. I think it's kind of like what stocks do you sell 2 summers ago when COVID was running wild? The hotel stocks, that was a low hanging fruit. Right now, the Fed is telling us they're going to go up. I mean, they're going to pull out the bonds. They're insisting on it, even when things are bad. So, I mean, it's kind of like they're giving it to you.
They're losing money all the time, the Fed.
Right.
That's the part people don't understand. Like, they're not only just like buying bonds, they're buying bonds badly. It's like a bad trader that's constantly getting their butt whooped.
Smacked every time.
So they have to stop doing that because it's unsustainable. It's not working. So they got to know that. Yeah.
Here is what else I think is going to happen. I think we're going to see a major reversal in information technology. It's been taking it under the chin, like payment processors.
For
They've
sure.
been really taking it under the chin. I think I think most of that is priced into the market because of the inflationary pressure.
PayPal.
Yeah, PayPal, Square,
Yeah.
Payc. I'm long Payc right now, and I really like that stock. It went up
Those are
100%.
great companies. Long
Yeah,
term.
these are really good, solid companies.
I
But
love that.
think right now you want to, and lastly, I'm becoming disillusioned with semiconductors. I think the shortage and all of that is so priced into this market. I think they've overreacted. I think I think a lot of the semiconductors are showing signs of stress.
Yeah.
So I'm not necessarily bearish on the entire tech sector, but here's what I do believe. I think we're going to see a rotation within the tech sector. I think the market capitalization is going to go away from the semiconductors and more into the info technology, as you said, PayPal, Square. So more into the software and the cloud space and away from the actual material. I don't see that basic material in the chips as I think that is already so priced in. I mean,
I'm really nervous about technology and growth stocks in general going forward for the next 6 months, because I don't see it. I see a backdrop where they're already like the premium's really high that you're paying. The multiples are really high on a lot of these names, and the rates with the Fed not supporting you anymore. I mean, what are you going to do? You're going to have to really crush. You're going to have to really destroy your estimates. And that's going to be a few. That's going to be a few companies. That's not going to be spread out for everybody. So I'm a little bit nervous for that sector. I think I agree with you on your base case that I think December will have a couple of shock down moves that will get quickly filled. VIX will stay a little bit subdued. And they're going to rally the stocks into the close, because we know how the sausage is made. These guys are not going to let their entire year, their entire bonus, their entire job, which is predicated on the returns they made in 2021, fall apart in the last 4 weeks. And they don't need that much volume to pin some of these stocks up, believe it or not. So I think there's cash on the sideline. The Fed's still providing liquidity. They're going to start to taper, but they have not yet. As it is today, they're still putting $100 billion into the bonds every month. That's going to translate to $1 trillion worth of cap buying power, 10 to 1 leverage that's going to go into stocks every month. And so I think that money keeps rolling in. I think stocks keep getting pinned higher. I think you buy dips, but I think you got to be super cautious in Q1 of 2022, specifically in growth technology. And as you mentioned, semiconductors and vulnerable areas like that.
Before I let you go, what do you think about solar? I'm just throwing it. I'm just throwing everything your way today.
I haven't been tracking them tight.
Okay.
I mean, how are they doing lately? I haven't looked at them in months. They've been months.
They've been starting to show signs of life.
Really? I know they were beat down harshly, like super harsh.
Really hard, but they're starting to show signs of life. They really
That's
are.
always a good sign.
Yeah. I think that's going to. I think we may see some more upside in those stocks over the next couple of quarters. Something to keep an idea in the back of your mind. Before I let you go, do you have any ideas, any trades, anything you want to throw out? Anything to our readers at home?
Well, I have my new monthly money flow. So I have a program that how I described, like these portfolio managers gaming the system, rigging the system so that they can get paid. I have a strategy that kind of front runs that activity that picks up, identifies when those type of momentum moves are happening in certain names. And today and tomorrow are the big days for my indicator. And when I see these atypical moves happening in these stocks, then on Friday, I'm going to have all these new trades to ride out December. And it worked really well last month. We hit a home run in AMD. Stock was up over 30%. The option was up multiple 100%. I had a short in eBay, which was over 100%. I had a short in CrowdStrike. And I'm agnostic. I don't, it's not really like a long-term view. It's just within the month. I see institutional selling, I see institutional buying, and I kind of front run them for the rest of the month, because they kind of they push that football across the goal line, if you know what I'm saying. And December is a huge month. The two best months for it are December and January. Right. Year end and year beginning.
Yeah. Statistically, the November, December, and January are the three most volatile, but the best months of the year. So
So for that program in particular, they're really good months because institutions have a lot of size to move.
I am so glad to hear that. Perfect. And folks, can you give the name of the program again? And it's
Monthly Money Flow Elite. Monthly
Perfect.
money flow elites. But there's
Folks,
there's a smaller version of it for people that are not used to me and not used to trading, and you get one trade. The other one, I'll give you 9. But if you
wow.
want to just try the one trade, it's monthly money flow. So perhaps they could check out either one.
I love it. Folks, check out Monthly Money Flows, Jeff Zananeri. Just go to wealthpress.com and you'll see Jeff's services.
Trades are coming Friday. They're coming brand new trades. So
or go to Joy of the Trade. And if you want to reach out to Jeff Zananeri, please do. He won't bite. It's jeff@joyofthetrade.com. My email is support@marketgeeks.com. Jeff, thank you so much. I'll let you get ready for the market today.
This was an awesome call. I really wanted to hear your opinion on some of these things because it's a hard time for a lot of people.
Oh, it's a very
Even
hard
for
time.
Us, it's a hard time to trust your eyes. Am I getting this right? Am I getting this getting this wrong?
Well, also volatility on major stocks is double what it usually is right now. What it typically is. So it's very hard for directional traders to not get stopped out and stay for the move. So it's one of those high volatility. It's going a lot, but it's not moving. You know what I mean? It's going nowhere fast. So
I know what you're saying.
People are frustrated because they're getting stopped out of positions. This is why right now you have to kind of change your strategy a little bit, allow your positions, lower your exposure, but allow your positions a little room to breathe.
Yeah, you need more breathing room. You need smaller size. You got to expect bigger drawdowns, bigger moves up in your favor. Like, don't get out of your winners if they're up 50 basis points and you're going to sit in a 5% loser. Let it run when you're making money too.
Right. Jeff, thank you so much. I appreciate the feedback. And again, jeff@joyofthetrade.com. And you can also see all of Jeff's services at wealthpress.com. Jeff, thank you so much. And I will see you next Wednesday. Bye.
Have a great week, Roger.
You too.
Thank you
Take
for
care.
watching, guys.
Thanks.
LFG.
Bye.
Bye-bye.